Hi, welcome to the T Minus Retirement Podcast, the podcast where we help launch your retirement into orbit. I'm Jay Cole,
I'm Dustin Watts.
And I'm Brian Owen.
and today we wanted to just regroup. It's been about, so we're filming this in mid-May right now, so it's been about maybe a month and a half just since we had the whole tariff scare within the market, for lack of a better term, and market's definitely rebounded. Ever since then. And so we were talking amongst ourselves and just wanted to regroup and highlight a few things that maybe you got scared within the market and cashed out, or maybe you're just very uncomfortable with where you're seeing your portfolio. So we just wanted to just highlight a couple things in regards to that and maybe kind of help you make better decisions going forward when it comes to just your portfolio in general.
Yeah, so let's start off with risk tolerance, I would say is a good place to start. So if what has taken place over the last month and a half has really frightened you, that is right now is a really good time, I think, to assess the fluctuations that were in your portfolio and ask yourself, are you taking on too much risk? Is there an adjustment that needs to be made? Of course, when we're in the midst of a downturn, and we had an extremely quick, technically bear market and some different markets, things start happening really fast. People start to make poor decisions out of fear. Of course, the news is really pumping up everything that's going on, and sometimes people really make the wrong decisions towards the bottom of these market events. But it's a good time now that the market has really made up all of the volatility that we've seen since April 2nd when tariffs were officially announced. It's a good time to ask yourself, am I taking on too much risk in my portfolio? Do I need to make a change? We don't want to make a change when we're at the bottom. That's the absolute worst time to make a change. And I know we're having conversations with clients during that time. Some, of course, were rightfully scared about what was going on. And, the question always comes up, do we need to make a change? Should we be going to cash? Should we be, doing something else? And when the market is as volatile as it was, and, I'm not going to sugarcoat it, the market was extremely volatile there for, a few weeks when we had, 2, 3, 5% moves, depending on the market you're looking at in a day. Those are really terrible times to make emotional decisions and change portfolios because, what happens on the other side of that? Typically, we have some type of rebound in the opposite direction. So I think it's a good time now that we're past at least the worst of what we've seen over the last month to assess your portfolio and really, probably more importantly, assess yourself and say, am I taking on too much risk? Now is a much better time to make a change if you feel like that is warranted than it was a month ago.
Yeah, because let's just say you're newly into retirement, and before, when you were working and contributing to your 401k, maybe you were fine with having more of an aggressive stance in your portfolio because we didn't need the money just yet, and you were constantly feeding it just with your contributions. And so even if there was a downturn, that monthly contribution would be buying up more shares of, whatever the 401k was in. So maybe now that you're in retirement and you're taking an income from your portfolio, maybe you're not comfortable with being as aggressive as how it once was. The returns might be great, but at the same time, if you can't stomach a 15% or even a 20% loss within like a huge downturn, then to Dustin's point, this might be a good time now that the market's recorrected itself to make that transition and maybe get into more of a 60-40 type portfolio or more of a balanced or conservative. Just depends on what your comfort level is. And it's different for each person. There's not going to be one solid answer for every single individual. It's just what you're comfortable with. If you're comfortable with that, the higher risk, then that's fine. You understand just that's how the market does. And you're fine with just waiting out the market to just eventually rebound.
I think something that gets overlooked a lot too is, it's May 15th, of 2025. We just had 2 really great years in the market, and it's really easy to be at a riskier portfolio position when the market's going up. It's like we all everybody wants to have their cake and eat it too, so to speak, right? People want to have
Right.
all the gains and none of the losses. And when the market's going up, it's easy to overextend yourself and to kind of forget about the downturns. Even though the last real downturn we had was in 2022, which really wasn't that long ago. But when we have an event like what we just experienced over the last couple of months, that is a true test of what your risk tolerance is. And so I think it's really important to just look at yourself and just come to terms with, okay, if I'm uncomfortable with the fluctuations of my portfolio, I need to maybe give up a little bit of that upside return for a little bit more stability, and that's completely okay. It's like Jay said, it's just what your preference is. Not everybody's at the same risk tolerance. Not everybody is, trying to hit double-digit returns every year. If you are, then you're going to live through the volatility and experience both sides. But some people want things a little bit more consistent, and now's a good time to assess that.
Yeah.
Yeah,
Now,
that's
go ahead,
sorry,
Brian.
go ahead. No, it's okay. I was just going to ask, I think it's important that we take a moment and just kind of define for anyone watching, what when we talk about, either taking on more risk or maybe shutting off some risk and going for a little more stability, what kind of selection does that look like? Like, what essentially would we be doing if it was us who were uncomfortable with taking on more risk after that shakiness in the market for the moment, or we had to take a risk-on approach and want to have some more? What would that look like practically?
Well, I can answer a little bit of that. So there's actually multiple ways that you could achieve maybe de-risking the portfolio a little bit. If it's, over the last couple of years, we've had extremely concentrated technology exposure that's done very well. Maybe it's just paring back some of those high flyers, so to speak. AI was a really hot topic last year in 2024. And some of those biggest winners were the first ones to be sold off, which makes sense, right? Because you have some of these things that are up, huge amounts. Well, that's where profits are. Those are the first things that get sold when we have events like this. So that's one way, is maybe, you want to maintain an equity exposure, because we know that stocks are going to have the highest returns over a longer period of time, right? But maybe it's just, what stocks do we own? Instead of owning some, the latest quantum computing or AI stock, maybe we own, a Johnson & Johnson type of stock, or maybe we own a dividend-oriented fund that is going to, or a value fund that's going to be, more steady, established type of businesses that are paying consistent dividends. That's one way to reduce overall, your overall risk, is just kind of get away from maybe the more speculative type of stocks. Other ways are to add different alternative assets to the portfolio. Maybe you have some type of metals, commodities. Those can help get you some diversification from just market exposure. And then also just the old tried and true method is, maybe you add some fixed income to the portfolio. Instead of having 100% equity, maybe you drop that down to have 75% equity and 25% fixed income. There's a whole host of fixed income that you can own, but high level, when you start to add some less volatile or less correlated assets to the market into your overall portfolio, that starts to really shrink the volatility that your portfolio will experience. And that is a method that kind of helps people sleep a little bit better at night, knowing, it's not moving around so much depending on what the NASDAQ or S&P 500 is doing that day or moment.
Yeah.
Yeah.
I think too, this is a little bit off topic, but just not being so heavily focused on the news when we have events like this happening, because the market might be down 20%, but maybe you're only down 7% or 10%, but let's just say half of
Yeah.
what the market overall is down. Okay, well, that's a good thing. In general, that means that however that portfolio is set up, it's set up not to mirror the market 100% of the time. It's
Mhm.
okay, your downside exposure was half of what the market is, and that's good. And so I think just keeping that in mind as well might help you make more of a clear decision on if you should reevaluate or just kind of leave things as is. Because if you just follow the news constantly and see the market's down, it's the end of the world, it's the economy is going to go be horrible for the next couple of years, and of course, yeah, you're going to want to. I don't blame you if you want to just cash out and just have everything in cash or buried under your backyard. But it's good to have that reality check. Just not believing everything is 100% true or 100% true to you.
Well, and I want to expand just real quick on one part of that. Is financial media is no different than any other kind of media. There's more clicks on websites and more financial shows that are watched when we're in a panic. And one thing to realize is when you see whoever on TV, presenting themselves as an expert, I'm not saying that they're not an expert, but when a lot of times they're talking trading and in and out of the market and doing all these things, and don't get that conflicted with what 99% of people do with portfolios. Most people are not in and out of the market on a day-to-day basis. They make it seem on TV like you should be all cash or all in or constantly going back and forth, and that is almost certainly a losing strategy long term. It's very difficult to do that. You're basically going up against computer algorithms and people with real money that are have just immense resources to put to these trading algorithms. So don't get it conflicted that you should be doing those types of trades when you see somebody on CNBC as the expert saying, "Oh, I'm out of the market. I'm doing this. I'm doing that." You don't know what that person's truly doing, and you also don't know what they're doing 5 minutes from now. They might be back in the market or what have you. So you just need to really take those things with a grain of salt. And honestly, during market panics, it's better to turn a lot of that stuff off and just kind of return to fundamentals.
Yeah. Now, Dustin, let's say that you did panic during this past month and a half and sold everything and just left your money in cash, just sitting on the sidelines. What would you say is the best strategy to get back in if you want to get back in?
Well, you have two options really, and the first option would be maybe you assess what risk tolerance you're comfortable with. Maybe back to our further topic, maybe you were at a too high of risk, so you cashed out of fear. Now going forward, you say, hey, maybe I overreacted. You can get back into the market at a different level risk portfolio in one chunk, and that might not be a bad thing to do. I mean, I'll share my screen here just real quick. I mean, this is a chart year to date of the S&P 500. So January right here, here's the high, that was February 19th. Here's the low of the 8th, I believe, was the low. And, we're right back here. So it's not like the market's gotten away from you at this point. Yeah, hopefully you didn't sell down here and now we're here. But even if you did, when you look at a longer term chart, like if we go out 2 years, we're not at a place that you can't get back in and kind of get back to business, maybe at a lower risk portfolio. So that's one thing that you can do. If you're still very uncertain about what's going on in the market, I would just say, you have to get that money back to work in some fashion. So
Hmm.
come up with the portfolio. Maybe you get back into it a little slower. Dollar cost averaging strategy, maybe you put in a little bit each month over whatever time frame you feel comfortable with. But it's got to be something, because you can't just allow that money to sit in cash for a long period of time, because what will happen eventually is if it's too long and you're not back in the market, is the market will get away from you at some point. I mean, I have talked to people that they got scared out of the market back in 2016 when Brexit and the US elections were happening, got out of the market, and they're not even in the market today.
They missed out on so much.
I mean, COVID was the same thing. We're way higher than we were during COVID. These types of events will certainly, they're scary. They're a part of the market. We'll have more of these kind of events in the future, but you can't allow fear to kind of paralyze you. You just need to have a portfolio that is set up for your risk tolerance, I think, is the most important thing. And probably the best advice is the quicker you can get there, that makes you comfortable, the better, because then you can kind of leave it alone, allow the markets to do what they're going to do, and get some years under your belt to get those gains again. But that would be my best advice, is to pick one of those two strategies.
Yeah. Yeah.
Real quick, while you just mentioned that, and I know this is something, as advisors, we talk about this stuff every day, but, for anyone else watching, how does someone go about determining their own risk tolerance? How do they determine what they're willing to handle?
Yeah, well, there's a lot of tools online, that you can use. I know we have one here at the office, and if you need help determining your risk tolerance, please reach out to us. But you can go through exercises that give you different scenarios, and as you walk through these questions, these programs will start to guide you and tell you, okay, after you get through the whole series of questionnaires, this is the kind of risk that they feel like you would be okay with. And then from there, you can play around. Now, that's a good starting point. And then from there, you can kind of play around with different portfolios. I think the biggest thing is using some type of software to determine really what the possible drawdowns are in the portfolio. Because, and we talk about this with our clients, is, okay, if here's the portfolio, here's the kind of 95% of the time we could be in this range, and here's that other 5% of the time that could be worse than that. Is that going to keep you up at night? Is that something that's just off the table? Because if it is, then we need to make adjustments. But if you can live through that, I think we all feel that you'll be better off on the other side of that volatility down the road. And ultimately, that's what we're all investing for, is for the future. So that would be my best advice, is to use a tool like that helps guide you to determine what your risk tolerance is.
Yeah. The interesting thing is back when the markets were just ripping right before they started to turn down with news of tariffs and whatnot. You had some people occasionally that said, like, oh man, the market did so well, and yet my account, if it was up 18%, my account was only up 13%. And the conversation, it kind of goes without saying, based on what we've been talking about for the last few minutes, is, with that safety of determining, what our appetite for risk is and what we're willing to see on a drawdown, at the same time, there's also a limit on upside potential. But if,
Absolutely.
for anybody watching, if they wondered why there was some safety built into their portfolio for investing, that's why. It's, when maybe if the markets were down, 5, 10, 15%, just theoretically, they were only down a portion of that. And so, you have to be willing to, so to say, take it all when it comes to, determining how risky you're willing to be with investing.
Mm-hmm.
Well, and to expand upon that just real quick is, a lot of people will say, well, why can't we just be all in when times are good and all out when times are bad? And, if it was that easy, then,
Everyone
would be
would
the
be
way.
doing it. Yeah.
Yeah, it's completely not that easy. We live in literally the most complex economy out there. That's why we build in some protection on the downside, even when times are good, because you don't know that market can turn like that. And then it can also turn the other way like that. I mean, you are not going to time all those events right. I promise you that. If you do it once, you're lucky. If someone tells you they do it all the time, they're probably lying to you. So
Well,
it's
the other thing too is that if these are taxable accounts, you're constantly buying and selling, buying and
Yeah.
selling. You could be triggering either either an unfavorable tax consequence, and if it's short term, then that's even more bad, especially if you're in a higher tax bracket. So
or wash
it's
sales.
or wash sales, yeah. Where let's say you trigger a loss that you're hoping you can get a tax write-off for. Well, if you've only held those investments for a short period of time, then sold it, and then bought it again immediately, it's not going to do anything. The sale's going to be just washed.
Yeah. No, I think having a plan for your portfolio going into before the volatility happens is really the best way to approach it, because like I said, one thing is for certain: over the next 10 years, we'll have a whole host of other events that happen that will cause some type of panic in the market. That I am sure of. We have to live through that and come out the other side to really reap the reward of investing. That's why we're all doing this. And it's just better to be prepared rather than always chasing your tail, trying to figure out what this economy's doing. I mean, economists get it wrong 99% of the time. So what makes us think that we're going to be able to predict what the U.S. economy does? It's so complex, it's nearly impossible.
Yeah. And I think it's good to look back at these events because, like you said, they do happen. They're guaranteed to happen in the future. But we always end up better. It might take some time to rebound from it, but it's not that this bad event happened and then 10 years later we're still worse off in the market. Usually it's always rebounded at some point in time. Could be a whiplash, just like how this last month was. Could be a couple years, maybe like the 08, 09 crisis. It's just you need time on your hands.
Yeah. Well, and to that point, if you don't, if you have portions of money that you don't have time to allow the markets to play out, that's money that you don't put at risk. There's lots of things to do with money that you might need in 1 year that you can't risk going down 15%. So you need to assess all those things before you put it into the market.
Yeah.
Well, we hope that you found this information valuable. If you did, please like, subscribe. If you have any questions creating your own portfolio, please reach out to our firm and we'd be happy to help you. But we look forward to seeing you in the next video.
Take care.
Take care.
Take care, guys.